When did you feel comfortable taking the leap? You took this step at a really young age.
It is not an easy answer for this, but if you ask me for a rule of thumb, I would say...
Today I'm joined by my longtime mentor, Schmidt, known for his Trident Opportunities Substack and as the co-founder of TrackTackle.
It's just looking for changes the market overlooks.
Since 2016, he has achieved a 33% CAGR, investing in penny stocks and microcaps. And most of what I know in this space, I've learned directly from him.
Once you become a full-time investor, you're fully dependent on your returns of your portfolio.
We'll talk about how he built his strategy, the risks and discipline required, and what others can take away from his journey.
5% EBIT margin or 5.5% EBIT margins. The most important aspect for my case is...
I'm so honored to announce that our main sponsor is microcapclub.com. When I first joined the club, I realized I had just entered one of the most unique investor communities in the world. It's a private network of 270 of the best microcap stock pickers globally. Since 2011, members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. It's where ideas surface long before institutions ever notice them. And if you're obsessed with finding great businesses early, there's no better place to be. Surround yourself with some of the best investors in the world by visiting microcapclub.com and applying to join the club. That's microcapclub.com.
It's a big pleasure to have you on, especially since we've been talking for the last year or so, basically every other week. And so I just wanted to ask you right away, you've become like a full-time private investor through penny stock or microcap investing, whatever you want to call it. What does this mean, and how did you do it for the people that might not be aware of this whole kind of community or what it means?
Yeah, good morning, David. Thanks for having me. What does it mean? Essentially, it means that I don't do anything else for a living other than reading documents of companies, and I tend to invest into the companies with the most interesting documents. At least that's how I describe it at parties. And most of the time, I don't get a lot of follow-up questions because I think you know how this works. When you meet someone at a party, the almost the first question is, what do you do for a living? And I don't like to talk a lot about investing with people that can't fully grasp how the stock market works, because it's a lot of questions and you get to the impression, okay, they are not really interested in it. So that's usually how I put it. And yeah, as I said, it's just about reading documents and trying to find something others don't find and invest your own capital. So I'm just managing my own capital. I don't get outside money. I don't plan to get any money from outside. And yeah, what was important for that to get to this point was not really investing itself, but maybe my previous professional life. Because if there's someone out there who's thinking about becoming a full-time investor himself, and is currently having a job which is they don't really like, but it pays off well, then I want to kind of give you the feeling it was the same for me. And I did this for 11 years. I worked as a consultant in e-commerce and a service provider in e-commerce. And I didn't like it from the start, and it was anything but fun. It was really exhausting. And but I always had this long-term plan to pursue investing full-time. So I stick to this professional life. And yeah, at one point I asked myself, okay, what is something I can really do where I can see myself in long term, which I really have the kind of passion for. And that was investing. It was pretty simple. Yeah. And when you also, another point which was really important for me to get to this point was, I would say, frugality, to live a rather frugal life. Because when I was earning my first money through my self-employment, I still drove a very old rusty car, a Renault Modus. You can look this up. All the listeners can look this up because this car is really anything but nice. And a lot of my customers told me, okay, why don't you buy a new car? It's kind of embarrassing, which sometimes shocked me because it was a perfectly good car. It drove me everywhere I wanted to. And yeah, that has changed a bit now. But at the beginning, I was very frugal. And because with every luxury good you buy, you have this kind of trade-off because you have less money for investing, right? So I decided to wait for a very long time. And then at one point I bought a BMW. And drove it for 8 years straight. So it took me a long time before I bought a new car. And that was at least as important as the investing side and the earning side for me finally to took the leap to pursue investing full time. Yeah.
Got it. And obviously there are some kind of rules out there. Okay, you should have like, I don't know how many years of expenses covered, but I'm really curious, for you personally, uh when did you feel comfortable like taking the leap? Because this is a very big step, especially you took this step at a really young age. So I'm guessing you were either very confident about your skills, or you had like a pretty decent like capital base to kind of guarantee that if you had to take a job or something afterwards, it would be fine. So yeah, just guide us through your thought process. Like, if you were meeting Christian at the moment of the decision, okay, let's take the leap, what was Christian thinking back then?
It is not an easy answer for this, but if you ask me for a rule of thumb, I would say at least what I thought is that I want to have the kind of capital when I put it into an index fund like the MSCI World, where you on average earn like 7% a year before taxes, then it should be enough then to more than cover your expenses, your annual expenses. And I also, as you just mentioned, I put aside my 1 year of annual spendings on a special bank account I don't touch. So that's the kind of conservative approach I take here in this regard. And I think it's important to really think this through. So look at your expenses. It's pretty common in German that people here have this, I don't know how it's called in English, but you have this kind of app or like a book where you list down all your expenses. So at the end of the
Okay.
year, you look at it and you say, okay, this is my annual expenses. And at the point I realized that through an index fund with like 7% return on my capital, I can cover my expenses and even save some additional money. It was a lot I could save additionally. I realized, okay, now might be the point where I should take the leap, because I was thinking about this a lot in the years before and always were hesitating to finally took the leap. And so
Hmm.
I think as a rule of thumb, that should be appropriate.
Got it. Yeah, that's perfect, because I've done like the calculation myself, but it's really hard because like I'm still a student and I don't have like the full visibility of what my expenses will be. But yeah, it's just, I guess, fun to go through that thought experiment, and maybe for other people that are listening that want to go through it and see, okay, when could I actually retire or like go full time private investing or something.
This can always change. For example, if you become a
Exactly.
father, your cost base
Yeah.
will be much different, and the earnings side will likely be less than before. So that's also something you should think through. Yeah.
Yeah, exactly. It really depends on everybody's situation. But taking a step back, I wanted to kind of go to the point when you first realized that penny stock investing or microcap investing was more than a hobby. So take us back to that time where you actually, okay, I'm kind of decent at this, and I want to take it seriously.
I think it was in 2020, because that was the year where the first time I earned as much or more from investing than from my self-employment. And
Hmm.
it was
Nice.
also through my own research, because at this time I decided to figure out on my own how I could develop approaches to find new investment cases. And at this time, it was very simple. I just took a stock screener and was looking at companies with a year-over-year revenue growth, which was impressive. So, and then after that, I went through all the stocks and was searching for something interesting. And one stock catched my interest, which was Celsius. I think you know it. It's
Okay.
the energy
Yeah, of
drink
course.
company. Back then, it wasn't that. Not many people knew about it, but
Right.
they had a impressive revenue growth. And at the point, on a standstill basis, I was very sure if they now would stop growing and try to get to a positive EBIT, it would be likely that they would be capable of it. And through my previous profession as an e-commerce consultant, I was able to figure some things out which other investors might have overlooked back then. Because,
Hmm.
for example, the engagement rate on Instagram, Celsius was like the goat of engagement rate back then. They had like a 4 or
Nice.
5%, something like that. It was really impressive. So for this kind of company, I think Red Bull, for example, had like 0.4% engagement rate, which means, okay, how much do your followers engage with your brand or your Instagram account? And also I tracked the sales on Amazon. At one point, they became the number one in the energy drink category, which is pretty impressive, because that means you're always able to calculate the exact amount of revenue through this when you had this kind of tools to figure this out. So that was the really first solid investment case where I was pretty convinced that I found something which could really work. And I bought it in 2019. I think it was something in the range between $3 and $4. And I sold a third of it at $24 and the remainder at like $60 a year after I invested into it. So it was like a 17 bagger.
Wow.
At least that's what I calculated back then, within a year, which was so nice. And I think they made a split, so you have to adjust these numbers. But yeah,
that's pretty cool, man. And yeah, I just wanted to double click on the alternative data kind of exploitation that you took. Like you basically used your past skill set as an e-commerce consultant. I imagine there are some tools like that not a lot of people are aware of. And so is that still like part of your process? And what kind of tools were you using back then that might still be relevant today for investors looking at D2C businesses that are in the e-commerce space, for example?
it depends. I'm not looking specifically at or deliberately at e-commerce companies. Most of the time, I'm just searching for certain search terms, and then when I found the e-commerce company, I immediately figure, okay, I can look this up with this tool. So track sales ranks. It's pretty simple. There are a lot of tools out there. If you go on Google and search for the term Amazon sales ranks calculator or something like that, you get a lot of tools you can use. And this can be very helpful because Amazon as a marketplace is very competitive. And if you manage to get your brand to the higher ranks, it means a lot. But only if you can manage to do this organically, because you can also run ads on Amazon and you have to adjust for that. It's not that simple. So most of the time, it's more about getting a feel for it. Okay, is this brand really a brand in the best sense of it? Or is it just that they put so much money into this channel that they get to revenues but never get to real profitability? So for me, I would say it's easier for me to figure out if an e-commerce brand is doing a great job or its management is doing a great job, but I don't concentrate on the sector. So
Yeah, I was really impressed when it came to TrueBar because simply better brands before. Because you always pulled out like this Amazon rank and how well they were tracking on Amazon and so on. And yeah, I figured there was like some tool that was helping you.
I should emphasize that I'm now very skeptical about TrueBar and its future. So just for the record, I'm no longer invested.
Yeah. Okay. Yeah. Awesome. Yeah. I love the disclaimer. And so again, going back to your journey, and then we can jump into some more like practical investing lessons, I guess. But it took basically two transitions from what I understand. Firstly, I don't know if you mentioned here, but you worked in banking at some point, and you transition to the e-commerce, and then you transition again to the full-time private investing. And I want to talk about some of the challenges that you faced, because obviously it's a very compelling idea to kind of work for yourself and just invest full-time. But I want to make sure people are fully aware of also like the drawbacks, because there's always like two sides to the coin. And so just guide us through like some of the challenges. How did you deal with them, and what are some of the current challenges you're still facing?
Kind of challenge. The biggest challenge was to stick to my previous job, until I had the capital to pursue investing full time. That was the biggest challenge, because it was energy dragging. It was a real energy sucker for me, and I don't want to get into detail about that. But sometimes if it's worthwhile from a financial perspective, I would say don't chase your dreams too early. Maybe stick to your current job, although you don't like it. But if it pays off well and brings you closer to the final goal, it might be a good idea to stick to it for a while. We talked about that recently, right?
Yeah,
And
yeah.
many people give you the advice: no, quit your job immediately. Do what you like for a living. And I'm not sure if this is correct. If you have this kind of goal at the horizon and it's really something you thought through, sometimes it can be a good idea to stick to your well-paid job, which you don't like, but at one point you realize it was right. And I definitely came to the conclusion that it was right to stick to this job, although it really attracted a lot of energy. The current biggest challenge is not to get fat and lazy, because what your 9 to 5 job or self-employment gives you kind of a structure every day
Yeah.
where you can stick to it. And the moment you are a full-time investor, some people think you read documents all day or you have meetings all day. That's not the truth. At least it's not true for me. And at the beginning of your apprenticeship, you might also have come to the conclusion, okay, what is this guy doing all day? Because there's not so much work I can give you to make sure that you
Yeah.
there's something you can do instead of me. So I think time is not an issue when it's about investing. It's more about mental capacity, or let's call
Yeah.
it mental bandwidth, something like that. Because reading documents 12 hours a day without someone pushing you to do this, I don't think that a lot of people are capable of doing that. So structure your way and structure your day in a way that you get this kind of excitement still. So talk to management teams, talk to other investors, ask them what they are currently looking at, and maybe discuss it with them. And I also now I have this kind of day where I really concentrate on you could call it hobbies, or yeah my work at home. For example, I care about my garden and all this stuff, and doing
Mm-hmm.
sports. And that's how I structure my day to not get into this kind of laziness, which can often happen, because right after school in Germany, you have a lot of time until your apprenticeship or your study start. And those were the 5 meaningless months of my life, because I didn't do anything at all, really. So
Yeah.
so it was the same was true for many of my friends at the time. We were pretty lazy, not doing anything at all, because you have so much time and you
Yeah.
can't really fill it with work if nobody pushes you to do that. Yeah.
Yeah, it's kind of interesting because there are two things I'd like to discuss. One of the things is, for the record, I think you gave me like the genuine private investor type apprenticeship, because I was going into it like thinking, yeah, I'll do like some projects here and there, and I'll have like a structured, yeah, just look at this company and give me like a report or something. But it was like just going into it, and at 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 first maybe you were saying, you were telling me like, okay, you can look at this or something, but then it was just like me independently like looking for things, and like out of my own kind of motivation trying to to get new ideas to show you. I guess part of the motivation was just your the next call. So like yeah, I was excited to kind of come up with something, because there was a time where not a lot of things were coming on the radar. So yeah, that's just for the record. And the other thing is exactly about the time thing, because I've had a discussion with my parents recently, and I think it's like the harder the job or task you're doing or commitment you have, the most efficiently you'll allocate your time, and the opposite
Yeah.
is also true. So if you have a bunch of time, then you'll just like kind of waste it. So I think it's good to strike a balance between, okay, let's not work too hard, but at the same time, if you're working too little or something you're comfortable with, I guess it's not good as well. So that's one of the lessons I took from you. So yeah, uh, that's nice. Um, yeah, so just also kind of going into more of an investing topic. And I did a thread maybe a week ago or something. And I feel like people really enjoyed it, because you bring a unique perspective and simple perspective to investing. And so I'm curious to know, how do you evaluate microcaps, and uh, how do you allocate your time, and how do you feel like, how do you know it's worth your time and money to investigate further?
I think the first part of the answer is pretty simple, and a lot of investors would tell you that, at least microcap investors. Microcap investors investing pays off if you go the extra miles. If you go the extra miles, you get rewarded for it. That's pretty simple, because there are not a lot of smart people looking at the same stock at the same time. If you go in the mid cap sector or the large cap sector, there are literally thousands of analysts and 10,000s of investors who are looking at the same stock at the same time, and there's not a lot of new information you can kind of dig out. If you dig further, there's not a lot of new information you get from that. For example, if you're now thinking about doing a write-up about Apple, I don't know if you could do it better than all the analysts out there, so it's pretty unlikely. But if you go through, let's say, all microcaps from A to Z in the Australian stock market, which I did, you can find a lot of things nobody heard about. And there are a lot of situations which the market overlooks or our investors overlooks. So that's the main reason why I invest into microcaps. When you ask me about the kind of approach, I start reading. I start reading, and I have a new idea. For example, I'm looking for specific search terms like adjusted EBITDA. So searching for companies that had maybe 2 consecutive quarters of positive adjusted EBITDA, and then I try to investigate further what might be the reason for that. So did they kind of a strategic review? Was there CEO change or something like that?
Mm-hmm.
And these are also search terms I'm looking for. For example, I use my own tool and some other tools, AI and all this stuff, to look for strategic reviews, CEO changes, and then I go through the list. And sometimes it takes months until I found something interesting. And that's also part of the process, which you have to get along with, that you sometimes you don't find anything at all for a very long time, and then you have to realize, oh, because if you really want to find something, this can also be kind of negatively affect your process, because
True.
you see investment cases, although those are not solid or not compelling investment cases. Maybe it's good for, let's say, 10% a year, but if it's below your hurdle rate, you should just go to the next stock and
Yeah.
accept that it takes time. So,
Yeah.
yeah.
No, sorry to cut you out. I just wanted to say that Christian is very humble, and so he didn't plug his own tool on here. But I think one of the key parts of Christian's process, just from observing him and like looking at how he thinks about things, is this track tackle. I'm not getting sponsored. I just use it myself, and I think it's great. So yeah, just wanted to cut you on here, because you say like, yeah, I use my own tool. It seems like you don't have like a proper like thing, but yeah, just you can continue.
Yeah, basically this tool was developed by my co-founder according to my own needs as an investor. So I was searching using the SEC tool. How's it called? Edgar.
Edgar?
Yeah,
Yeah.
right. And I wouldn't even say that it's bad from a usability perspective, but it has kind of disadvantages. And I often used it, and we're going through all the stocks which had a strategic review, and then I was looking at them. Okay, I realized, oh, it's a 20 billion market cap company. It's not interesting for me. But that was kind of my approach to search for specific terms, and then go through all of them and see if there's something changing, which at first place other investors overlook, and which is really worthwhile. So I try to look at the companies after these changes materialize fully. So how does the company look after these changes have fully materialized? So is it trading at like 5 times EBIT? Then I try to figure out, okay, is this cheap compared to its peers, or is it interesting from a pure yield perspective, because those are recurring revenues? They are likely perform well even in a recession. So that's the kind of things I try to figure out. And yeah, as I said, essentially it's just looking for changes, and something changes the market overlooks. And so most of the time I'm looking for changes that are not too obvious. So there has
Yeah.
to be some kind of changes in the competitive environment, for example. Yeah. And so because that's I would say part of the extra miles I was talking about, because a lot of investors look at the environment. They are just looking at the documents and don't dig deeper after that. So yeah, that might be a good idea how you can find solid investment cases.
Got it. And one thing for people that might not be fully kind of aware of how microcap investing works is that if I go through your portfolio and just screen it on a regular screener, or like look up the financials and so on, they won't look very clean, right? Or at
Right.
least
Yeah.
right away when you start the investing. So can you guide us through, because you mentioned like, oh, if it's trading at 5 times EBIT or whatever, like, uh, can you guide us through how do you do that forward looking evaluation? Because from what I understand and from what I've learned from you, like the past is interesting, but it's not always an indicative of the future of the company. And sometimes investing in those ugly kind of companies gives you an edge or an advantage. So yeah, just guide us through how you think about this.
Yeah, to put it simply, I try to normalize the earnings. So as you said, most of the time when I look at those companies, some of them never really show the profit, and especially not an US GAAP profit or an IFRS profit. So based on accounting standards, they never show the profit, and often they had some issues in the past which led to certain costs. And for example, a roll up that didn't perform well, they most of the time have this kind of customer contracts and brands which are getting amortized, and they it's not a cash cost. So, but those costs um, are still part of the income statement, and so they show a negative profit. That's something which I normally adjust to look at the more like normalized cash flow they can generate. So that's something I'm looking at, and also if they, for example, just recently acquired a new company, I'm looking at the potential savings from that and how the company might look after that. I'm just doing this kind of very simple back of the envelope calculation. So
Mm-hmm.
my valuation work is now much more simple than it was before. Before,
Yeah.
I think 4 years ago, I still did this overly complex DCF models, which with this massive spreadsheets. Really, you can't imagine. I deleted all these spreadsheets because I never want to look at them again. And it took me like 8 hours to just fill in the numbers correctly. I'm not exaggerating. It's really the case.
Mm-hmm.
And so now my valuation work is pretty simple. And I'm just want to figure out from a financial perspective if it's going in the right direction. It doesn't have to be perfect. So it's not relevant if they generate like 5% EBIT margin or 5.5% EBIT margin. That's the most important aspect for my cases is that they get to a profit, for
Yeah.
example. And because sometimes those are distressed companies and they have a large debt load, and in the past they were not able to cover the interest expenses. So if there's any kind of visibility for me that I can anticipate those changes, that's the most important aspect, and that's part of my valuation work. So I got a very simple spreadsheet. I often share that with my readers on my Substack, for example, which is it's just like that. That's all I do from a valuation perspective. And yeah, I think that's key for microcap investing, to search for cases which are so simple from a valuation perspective that you can easily explain them to others and
Mm.
also to yourself. But from the perspective that the market overlooks it, it should be a bit more complex. So um, if you find a company that's trading at 5 times EBIT on a US GAAP basis, there might be some issues you yourself overlook, and you have to figure it out, because there are a lot of companies which are trading at 5 times EBIT and were not discovered.
Yeah, exactly. So essentially, what you're doing is looking at companies that will be trading at 5 times forward EBIT, or are trading at forward EBIT. or when things like kind of normalize, right? Um, so yeah, let's take a practical approach to this, and I always like to kind of get a sense. Obviously, I already knew you, but in general, I like to get a sense of what's the investor's approach, and I'd like to, if you could like kind of use your own principles to explain a case that you just want to give to my audience, like a case study or something of an idea that you looked at recently. So yeah, if you have any specific example where we can see your principles and framework applied, that would be extremely useful.
Yeah, maybe a case from the past. I can also share an ongoing case, but a case from the past which was pretty was not that compelling to the readers I shared it with. Was RegisCorp. RegisCorp is
Okay.
has this kind of hairdresser saloons, and they had a huge debt load. And at one point, it was pretty clear that they made a strategic review, so that can be the start of the investment case. And the debt
Right.
load was so high that they were barely able to cover the interest expenses. So, as I just said, that's a perfect example for that. And if that would be the end of the case, it would be not interesting to me. But there were a lot of activists which came into the stock and were trying to convince the management to not do this kind of highly dilutive raise,
Right.
capital raise, which would have led to a, let's say, 90% drop in the share price, although it was already distressed. And at some point, I think it was at noon CET, where the west coast of the United States were likely still sleeping because it's a US company, US-based company. The news came out that they were able to get a debt forgiveness for half their debt. And if you looked at it from an EV basis, that was impressive. And I was sitting there and trying to figure out, okay, why is nobody buying this before the market opens? Because it was trading like at $4 a share.
Mm-hmm.
I had a lot of time to figure this out, which is insane because normally, if you would think about a stock like Apple, for example, it would take a second and the stock would rise massively if
Yeah.
you would be able to pull this off. And so I was essentially the first one who was buying the stock. And then I was discussing it with other investors, which is also part of my approach, a very important part of my approach, because it really helps to have this German friends, which are also investors, because they're very open with criticism. And I did send them the sheets and all this stuff. And hey, look at this. I told them, and this is the new cap table. What do you think about it? It's not dilutive at all. And they were saying, yeah, I think you're right, but you know much more about this. But I think you're right. I'm also buying a position, and I was buying massively before the market opened. And before the market opened, I think it was trading already at $7 a share. Before that, it was trading at $4. And at the end of the day, when the market closed, it was trading like at $20 a share. And
Wow.
this was kind of the final realization moment where I thought, okay, microcaps are really a different game. You as a private investor are capable of doing things without getting interrupted by the bigger players. So
Yeah.
you figure this out. And there were a lot of US investors who also were discussing it with me in WhatsApp groups and all this stuff. And essentially nobody was buying because they were also skeptical. How were they able to pull this trick off? And I figured that it is today. It's not important how they made it. It's just okay. Previously, everyone was thinking, okay, they likely go bust, and now this is off the table. So yeah, it was pretty simple. Yeah.
Yeah, but I think for the people listening, they might be thinking, "Oh, this is so easy! Like you just move to Germany and stay awake a couple of hours before the US guys wake up, and yeah, just buy companies that are full of debt, and they were able to refinance." But I'm pretty sure there was like a lot of work on the back
Sure.
of it, right? It was like, so you essentially made all the returns in one day, or most of it in one day, but you were doing a lot of work before that. So just wanted to leave this disclaimer, because otherwise all the traders out there will start trying to do microcap investing.
That's kind of annoying when people think, okay, it's so easy, I can also do that.
Yeah.
It was so simple. No, but you had to do the work before this news came out. So you have to kind of have this foundation to
Yeah.
interpret what's happening. So as soon as the press release comes out, your valuation work should be at its end, basically. And
Yep.
then you can just fill in the new numbers in your spreadsheet, and you realize, okay, now it's trading at half times the EBITDA than before. And so that is the most important aspect. And I would definitely not recommend it to invest into this kind of situations, because at this time I was already a full-time investor, so I was able to immediately digest the news, and I did the evaluation work and was able to come to a conclusion. So for me it was pretty simple at the time, but in general, I think it was before that it was like a 1 or 2% position in my portfolio. It was not more than that, because there was a certain likeliness that they will go bust, and so those kind of situations will never be a big portion of my portfolio. So yeah.
Yeah. So I want to also dig into your kind of selling and buying strategy, and not in the sense of like okay, let's buy a full position or sell or exit a full position, but more on the trimming and kind of averaging up or down, because I feel like that's much more nuanced and it requires much more experience. Because, for example, there are times where I know that the stock is like kind of, yeah, just trading higher than I expected or something, and I should have trimmed. But then there are other cases where they actually exceed your expectations and you were like analyzing something and missing something. So uh, do you have a general framework that can be applied? And then if you can give us a specific example, because obviously it really depends on each case, and maybe that will help give a better picture. Yeah.
Yeah, it really depends. Depends on the kind of visibility. So if I can anticipate the next few quarters, and I think the downside is rather limited, then I often make it the full position. A full position for me from the start is like 5 to 7%. If I invest into this kind of turnaround cases like Regis or Eridex, which I recently talked about, it's more
Yeah.
like 2 or 3%. So there are a lot of stocks which look very tempting from an upside perspective, but there's a reason for that, right? If you have an 8
Yeah.
times upside or 8% upside, it often comes along with 90% downside or something like that. So it really depends on that, because once you become a full-time investor, you're fully dependent on your returns of your portfolio. And maybe that's another challenge for a full-time investor, to get to this conclusion finally, to that you no longer can do this kind of weird stuff all the time and do this with half of your portfolio, because the most important aspect is to stay in the game. And
Yeah.
as you know, I don't like to talk about the stock market as a game, but I think in lack of better terms, which is the right expression. And so I try to really concentrate on the downside. And sometimes if I just exited the position because the multiple expansion was massive, and I figured out, okay, the upside is no longer that compelling, I just build up cash or put it into my, I would say, rather boring ideas, which kind of generate constantly this 30% return every year. At least that's how I look at it. And the remainder, I just build up cash and wait for the next nice, compelling idea. And there are no real rules for my portfolio. So I'm always
Yeah.
skeptical when someone tells me if a stock falls 50%, I sell immediately because that means
Yeah.
something blah blah blah. No, that's not the case. I often say investment is more art than science, because if I would ask you now, hey David, I got a good company, bad company setup, a good business, bad business setup, and do you want to invest? What would you say?
It depends on
Yeah,
the
right.
case, right?
It
I have
depends on a lot of
to go
things.
through it.
Yeah.
Yeah.
For
Yeah.
example, it depends on the meeting with the management, because that's also something I do very often, to get a feel if they really do something which they are convinced of, or also if they are consistent. And try to inform shareholders in advance about certain things that are going to happen in 1 or 2 quarters. Management is a very important aspect when you invest into microcaps.
Yeah.
So it really depends on the kind of situation. So I got no real rules for my portfolio. There's just one rule I stick to not let a position grow over 20% in my portfolio. So once a position gets over 20%, I reduce it. It's just
Mhm.
because at the beginning of 2024, I had 2 big positions in my portfolio, and they both at the same time, I think it was a week between those issues, they had some real problems. So which led to that the first quarter of 2024, I had like, I think I was 5% negative, at 5% negative returns. So that was
Wow.
kind of challenging from a psychological perspective. If the market would have been in an overall drawdown, it would have been totally fine, but it was not the case. There were a lot of guys out there posting their shiny year-to-date performances, which I didn't care that much about it, but still, it was, for me, it was like I did something wrong because I had 2 big positions and both at the same time had issues. So um, I now have a much less concentrated portfolio than before. 2 years ago, I had like 7 to 8 positions. Now it's more like 15 to 17 positions.
Yeah, I just want to jump in on 2 things. First of all, let's highlight that Christian said that his boring companies return 30% a year, and and that he was really sad for a 5% drawdown. So yeah, not drawdown, but yeah, negative return. And I'm not saying this to make fun of you, but it's just that uh, is to highlight how consistent your strategy has been over time. Obviously, we can speak for the future, but when people think like, okay, 30% returns, this might be super like volatile, and it can be volatile throughout like quarters or like, but over time, like not even that much time, it's kind of consistent, right? What do you think?
Yeah, it was consistent the last few years, but the last year when I still was doing this kind of part-time investing, part-time
Yeah.
consultant, I had the worst year of my life. I was down.
Hmm.
I think you can look it up. It's on my Twitter account. 28%. I was down. And it now would be easy to just say, okay, it was the situation, it was not me as an investor, because right before Christmas, it's the busiest time for an e-commerce consultant service
Yeah.
provider. And at the time, I think it was in 2021, the stock market went from 152 new week high to the next one. And I was just accepting that. I was not looking at my companies because I was so kind of obsessed with my work. And I didn't even read the press releases of my stocks, although I had back then I already had this kind of approach to digest every news that it's out there about my
Yeah.
companies. And yeah, after that, I decided that in 2022, I had one big position, which was like 40% of my portfolio, which was HelloFresh. I invested into it at
Oh.
€8 a share. And I did this kind of DCF valuation. And my bull case, it was like, I think, €95 per share. And the
Wow.
stock went through this mark above it. I think it was like 97, €96 per share. And I didn't sell because I was so obsessed with my work at the time. And I didn't have the mental bandwidth to, even think about my stocks. And after that,
Hmm.
I said, okay, I have to make the decision now to pursue investing full time or use a different approach. So I wouldn't say that my approach was consistent back then. It was a lot of, I had a lot of drawdowns, and in general, I was up all the time because I had things like Celsius, as I mentioned previously. But now since 2022, I really came to the conclusion that a lot has changed since then, and I'm co- concentrating on my portfolio all the time. So every day I'm reading news, I'm reading press releases, all the filings that come out. So I'm fully aware of everything that's happening, and I have control over my decisions without getting obsessed with something differently. So that has changed definitely, and I would still say I'm also doing some kind of weird stuff. So where the case is basically to sell it to the next bigger idiot, but it's only about 5%, 10% of my portfolio. Yeah.
Mm-hmm.
So
Makes sense.
yeah, I would say right now I'm very convinced of my portfolio and that how it will perform in the market drawdown, because we saw that at the beginning of the year and it performed really well against all this, like against an index like MSCI World or S&P 500.
Mm-hmm. Yeah, for sure. And you also mentioned like management before. And I wanted to ask you this very honest and not racist question. How do you ask more German questions?
Okay, yeah, that's difficult. Sometimes you get eyeballed, side-eyed from management teams because you ask this kind of questions they are not used to. Yeah, and maybe it's a good idea from the start to tell them, hey, I don't want to offend you. It's just that I want to get to the real relevant information, because most of the time you only have half an hour or an hour to ask questions, which is not a lot, because before I make this kind of appointments with management teams, I try to digest all the news and then all the information that is out there. And normally you still have kind of this materially operational questions to fully grasp what they are doing and why they are doing it. And also capital allocation is most of the time something which they don't talk that much about it. So you have to ask them, okay, you have 10 million in cash on your balance sheet. What are you planning to do with it? So that's something which always gets into kind of discussions where you can always also tell them, hey, that's how I think about it and what I would do with it if I were in your shoes. And I think there was never really a CEO who was offended by my questions. There was one CEO of a Canadian company who also at the end of the meeting said he was thankful for the kind of experience to get asked more serious questions. So I think if you make clear from the start, hey, I don't want to offend you, and maybe sometimes I can't hide my Herman the German DNA, and yeah, they get along with that.
Nice. And how do you design your questions? Obviously, is case specific, but I'm trying to understand like what makes a good question, uh, and like you can ask really great questions, but if you also don't put the management on the spot to give a good answer or like actually expand on it, or making them comfortable to share. Obviously, it's not like anything material, that insider information, but um just so they can like explain things properly. Like, do you have any tips on that, or it just comes natural to you?
I don't think I have any real tips. It's for me, it's pretty simple. I digest all the information, and then there are some questions left, and I ask them, and just try to figure out why they are doing the things they are doing. That's pretty simple, and it's not about the next quarter. It's just about the overall strategy. And
Yeah.
if the things they tell you in advance, which are going to happen in 1 or 2 quarters, actually materialize, so. And we are not talking about revenues or adjusted EBITDA. We're talking about, for example, yeah, we are thinking about doing a buyback. And it's very likely because a lot of investors let us know that they would appreciate it. And if they don't do it, yeah, you have to ask in the next meeting, why didn't you pursue the buybacks, for example? And yeah, those are very basic questions for follow-up meeting. And most of the time it's about that. Okay, why didn't you pursue your plans you previously mentioned, or why is the operation still in this kind of bad situation? So that's something which I tend to ask, but there's no secret sauce in this regard.
Got it. Got it. Yeah, and I also I'm kind of shocked that we haven't talked about market dynamics in this conversation, because I literally never heard that concept before, like meeting you, and I think it's also an important part of your process, and you have kind of your own definition of what it means. So I just wanted to ask you on that, and how can people kind of start at least considering a bit more like market dynamics and uh, the role it plays in investing?
Yep. For me, it's a kind of a mix of certain things. And in general, I would say it's whether the conditions for stock are now in favor of the stock. So, for example, it's about shareholder base. How do they think about the stock currently? How is the chart set up? I don't care about chart analysis that much, but sometimes you get to the point where you realize, okay, there might be a bottom, and now there might be a reason why this chart made this kind of bottom and is now on an upwards trend. When I invest into a company, most of the time I want to be sure that I can anticipate the next few quarters and that the stock is in an upward trend. So, and there might be good reasons for that. So, we recently described our approach, or at least my approach, as catalyst investing. So, you want to have this nice catalyst, which often come along with some shiny press releases the company can put out. And through this, if you only want to invest for, let's say, like 3 to 4 quarters, you want to be sure that you get into the stock at a point where they are in the middle of the upward trend, or at the beginning of the upward trend, or even before it, right before the upward trend starts. And there have to be some really strong arguments that you can make to explain it to a third party, for example, that the upward trend now starts and it's getting fueled by information all the time. So, for example, if a management team tells you, hey, we are planning to do a strategic review and we're looking at increasing shareholder value, and we are looking at all the assets and thinking about maybe selling some of them or selling the company. And then you look at the company and you see they have let's say, a low ROI assets with a lot of capex, which with low margins and all the stuff, and then a high ROIC segment with low capex and very high margins. You might figure out that they likely gonna sell the bad asset, the bad company, and stick to the good company. So that, for example, could be something you can figure out in advance, and then the moment they actually put out a press release that they are going to sell the bad business, this often comes along with a stock price increase. And then the next few quarters will likely look better because they can put back the money into the reinvestor, the money they get from the asset sale of the bad company into the good business, if it's possible. So if they are still able to grow that. And then you get this kind of 2, 3, 4 quarters where you have this nice year-over-year increase in adjusted EBITDA and revenue. They could get to even US GAAP profit. So that's, and when you ask me about market dynamics, so shareholders are aware of that. They see that, okay, another press release and all is going according to plan, and then this often comes along with a multiple expansion, a massive multiple expansion. And the moment people start to ask me about the next quarter in more detail, and I get this kind of DMs on Twitter, and I really get a lot of them. I can't answer them all, so sorry guys if some of you are still waiting for an answer. David knows that I sometimes need a bit more than 2 days to answer. Once I get all these messages asking me so very specific details about the next quarter, I position myself to the exit. So I often reduce my position. I also, it's not there have to be other arguments which are no longer in favor of the stock. So it's not only that when people write me DMs, I think you figured that. But it can be one of many indicators that the stock has now left its upwards trend. It's now getting more difficult. So they managed to do this kind of turnaround, or the situation you anticipated materialized, and now it's a different animal. So you're looking at something different. And you have to figure out for your own, if you really want to touch this kind of different valuation work, where you have to figure out, okay, how is this the competitive advantage of this company, which is totally fine. You can also look at the stock at this time where they were able to do this turnaround, and now are in a pond with many other fishes who also try to get their market share. And yeah, but most of the time I try to keep my cases simple. So I want to invest into companies before this upward trend starts, or in the middle of the upwards trend with some nice press releases. All investors are happy because the upward trend is getting fueled by many information. And yeah, that's how I look at market dynamics. And
Yeah. It's basically a mix of sentiment, momentum, and like just the right setup when it comes to timing of the turnaround or like the inflection, because it's really like you're investing in the change of something. Either they're selling an asset or they are launching a new product that's promising. So yeah, I think it's very interesting, and not sure if anyone kind of uses that framework as you described it, but hopefully some people can start learning from it, and just experimenting and see if it works or not. Nice. So I have a selfish question. Obviously, you already gave us a case of RegisCorp, and it was extremely interesting. But I would love if you'd be open to talk about Eridex. I think it's one of your most recent cases, and so yeah, it would just be interesting. Obviously, this is not investment advice. It's just like a showcase of Christian's kind of process, and yeah, I'm just curious to know a bit more about that company.
Yeah, as you said, it's a turnaround case, so people should be aware that there's a certain probability that this is not going to work, because this company, I think, over the whole history, they never showed a profit. They were constantly burning cash, a large amount of cash. They had several strategic investors who put money into the company, and still they were never able to be cash flow positive, exchanges in working capital. So no real cash flow, no real cash flow. So it's a US-based company, and they are in this kind of they're a medical device company with a razor blade model. So they sell systems, for example, glaucoma treatment, which is very common among elderly people, and also get recurring revenues from probe sales, which you have to use to treat those eye conditions. And as I said, they never really showed a profit. And recently there was a CEO change, which can be the start of a compelling investment case. It was a CEO from the inside, which I often do not prefer. I prefer an outside CEO who's looking at all the things and says, okay, there are no sacred cows. I don't know anybody here. I want them to get fired. So it's pretty simple. So that's why I like an outside CEO much more than an inside CEO. But in this case, I think I give them the benefit of the doubt, because what they are telling me sounds pretty impressive. And the start of how I came to the conclusion this might be the start of this upward trend I was recently talking about was 2 consecutive quarters of positive adjusted EBITDA. So I think I don't have to explain to your listeners why I look at adjusted EBITDA. It can be something like an early warning sign. A warning sign is maybe the wrong expression in this respect, but I think you know what I mean. So it can be an early indicator for changes in a company, because often before they show a real profit, you see a positive adjusted EBITDA. And then if you have to figure out, okay, what is changing in the company? And currently there are a lot of changes in this company. For example, they fired half of their sales staff for their glaucoma business, and we're still able to grow the business, which for many of my cases is true. For example, Covalon Technologies, they also fired even more than half of their sales staff and were able to grow their revenues. And it's always the case, often the case for this kind of business, because a lot of sales staff is doing nothing at all. I know a lot of salespeople, which are my friends, and I know what they do. So, most of the time they are in the home office, and I see them drinking wine on the balcony and all this stuff. And they were doing a lot of things. So they were kind of doing this kind of restructuring, which often comes along with getting people fired, and still were able to constantly keep their revenues constant. And also they produce in I think the most expensive area in the world. They produce some kind of commodities, and which is in Mountain View, California. So I don't know if you could think about a more expensive environment to produce commodities. It doesn't make sense at all. And for them, it's pretty obvious that they don't have this kind of sacred cows they don't want to touch. Because you could be skeptical, because if you have an inside CEO, an inside CFO, which was the CFO until 2020 and now came back in January of this year, you can be very skeptical about the efforts they are putting into the company. But so far, they made all the right moves. They were cutting a lot of costs. They were also cutting back on R&D, which could hurt the company long term for sure. But now it's pretty important for them to show profit, because they had this kind of strategic investor some quarters ago who put in 10 million into the company at $2 a share, and the stock is now trading at 1.2 million. So there are a lot of things going on, and also they got some tailwinds. So the reimbursement environment changed in their favor. So because their reimbursement was not cut back, but the the reimbursement for the treatments of their competitors was cut back. So that is something which I would consider a real tailwind right now. Although there are some people which discuss if the Trump bill, the big beautiful bill, you know the stuff, could hurt their business. I'm not so sure about that, because that's a rather long-term thing we are talking about. All this disenrollments from Medicare, Medicaid. I don't want to get into detail about that because it's very complex. And yeah, I think in general, the recent quarters have shown that the environment is changing in the favor. At least there's some indicators for that. But the last quarter also had this kind of special effect where they had a supply issue for their probes, and their probes are much more important than the systems, at least from a margin perspective, because on the probes they have a kind of 70 to 80% cross margin, which is pretty common for those medical devices companies. And on the systems they get, I don't know, they never disclose it, so we don't know how much cross margin they get onto them. It's also not that important, because it's like the systems are the foundation for selling probes, right? And I would concentrate on the recurring revenues in this regard. And I would also say there are some risks, because the strategic investor did give them 10 million because they wanted them to cover the expenses, but they can put additional 10 million into the company to do M&A. And most of the time, I'm very skeptical if a company tells me, hey, we want to do an M&A transaction to get to the kind of synergies so we are getting profitable. So if they would say that, which they don't really do, I would be very skeptical and would not invest normally. But I would say that's the biggest risk for the stock. Beside that, the environment is changing again in a way that's no longer in their favor. So I would be very careful about that. But I don't think that they would get this kind of 10 million transaction now, because, as I said, the strategic investor invested at $2 a share. And if they now would do a kind of acquisition, it would likely cost much more than 10 million. So I'm very sure that they also have to do a raise, and they would never raise at this valuation, because currently they are trading at like 0.5 EV sales, which is pretty low for a medical device company. If some of the listeners now think, okay, that's not meaningful at all, who cares about EV sales? Let me tell you that a lot of medical device companies are getting valued at EV sales, because most of the time there's a bigger fish out there who's looking at this company, and if they acquire them, they will immediately cut the SG&A costs to basically zero. So that's how many people look at it. For example, Lenza, which is also a US-based company in the same sector, was recently acquired, I think, for like 8 times EV sales. But their technology is much more sophisticated, I would say. So we are still talking about a turnaround company with some solid assets, but with many issues in the past, many sacred cows in the past, which were not touched. So, but in my opinion, the CFO and CEO now show us that they really want to, yeah, kind of conduct this change in the company.
Yeah, perfect. I think you covered it all, because like I was going to ask about the risks, but you ended up yeah, uncovering them in the end. I think it's a very interesting case, and obviously it kind of shows your process at its full, because it's an ugly kind of situation, or at least it was in the past, and you're uh, basically betting on the change of it. And I'm curious to know, for example, in this case, or if you look at your general approach, for how long are you looking to hold this type of investments, and how does that actually compare to reality? So you have like an intended holding period, and then you actually check out your portfolio, and maybe you're doing something different. But
It's a very good question, because initially I thought about holding it for like 2 to 3 quarters, because I was thinking, okay, they're showing one positive adjusted EBITDA and then the next positive adjusted EBITDA quarter and all this stuff. But then they had this kind of supply issue, and based on my back of the envelope calculation, they would have shown like 0.4, 0.5 million adjusted EBITDA in the last quarter, but through the supply issue, they only showed like 20,000 positive adjusted EBITDA. So that was something I really don't like, because, as I said, I want to get invested into a company when they are on an upwards trend, and especially during a turnaround. So there are not a lot of people which give them the benefit of the doubt after they have shown such a quarter, and they only explained it in the earnings call, which is also not a good idea. Your press releases have to be structured in a way that all investors which don't go the extra miles immediately understand what happened, and not doubting what you're saying. So that was, unfortunate, I would say, at least. Most of the time I would say 2, 3, 4 quarters. That's the case for my catalyst investing stocks, where I think, okay, something is changing and the market will react positive to that. And it's interesting, most of the time it works that way. I'm only invested for like a year. But for the stocks where I thought, okay, this might be a long-term investment, something really bad happened all the time, and or something which really made me come to the conclusion, okay, this is not a long-term investment. There are some real issues, and I think
yeah,
that's also something people should realize when they invest into microcaps. There are no sleep well investments. I never saw them. You always
yeah,
have to buy and hold and check, at least. Check is the most important aspect of buy and hold. You have to read every press release, every filing that's getting released, to really check if your thesis is still solid, and if you allow yourself a thesis creep, because that often happens. Innovative food holdings, I have to mention it, because there was a kind of massive thesis creep where the management also gave us the impression, okay, we know what we're doing, and although the thesis has now shifted to something different, we're still knowing what we do, and it really felt like that. But at one point, which is also pretty important to figure out on your own, how the next quarter might look like and what the market wants to see, at least if you're a catalyst investor. It's very important to set your own expectations. And there was one quarter where the expectations were not even, the real results were not even close to my own expectations. That was the moment I sold. I really thought innovative food holdings might be a kind of investment where I want to be invested long term. But at some point I had to realize, okay, it's not going to work that way. It's totally different than I expected it to be.
yeah. It's very interesting because I remember. I think we already talked about this several times, but I remember like texting you. Look, I think innovative food holdings looks a bit expensive, and you said, yeah, I think too, and I'm selling or something, and that was like kind of from my point of view, from my side, it was kind of interesting because that kind of marked. I'm not saying I timed it, obviously, but um, it, you just have to be so aware that these companies are extremely fragile, and when valuation gets a little bit ahead of itself, or at least it doesn't make sense from an IRR perspective, maybe it could be a good time to start trimming. And I guess you also have to be extremely comfortable with your portfolio at any given time. Because yeah, if you're not comfortable, then it's hard to make rational decisions. I at least for myself, I don't know how it works for you.
Yeah, but especially for innovative food holdings, I think I told you, they have to be expensive, because at one point they want to get into this kind of M&A flywheel where they acquire other companies, and the most important currency for M&A, or let's say roll up is the stock price. So your stock price has always to stay high to make sure that you get capital at, let's say, 20 times, 30 times EBITDA, and acquire other companies at like 5 times EBITDA. So that's how I thought about innovative food holdings. So I was comfortable with the very high multiple. But at one point, they questioned their M&A strategy. So they were telling us, okay, we are no longer sure if this uh, the synergies on both sides are really materialized. And that was the point where I thought, okay, that's too much. Now the thesis has changed massively from, at least from my perspective, how I looked at this company, and they are no longer worth this kind of valuation. And before that, I already reduced my position because they were no longer consistent. What happened was not consistent with what they told us some quarters ago. I don't blame them for it. So not for this aspect. So often it's not about blaming the management, it's just about consistency. And if they are able to really outweigh certain headwinds they are currently facing. So if the management team is not able to do that, you likely should not trust them, but ask yourself if you really want to stay invested, although you trust them. Yeah, maybe that's often something I think about.
Yeah, definitely. Consistency is both good from like a stock price perspective. So like a stock will, or like a company will be rewarded with a higher stock price if they're consistent, but also like from a management assessment perspective, I think, at least from what I understand, from what you said. Just to wrap up, I wanted to ask you maybe an unrelated question. So, for some people that might not know this about you, you're really passionate about history, and I just wanted to ask you on what sort of lessons, or if there's anything you learned from studying history that you think it's worth sharing when it comes to investing.
Yeah, I think in the first semester when you study history, I studied history. I never made it to the bachelor degree, but I studied history and I really liked it. But my self-employment, was the reason why I quit. And the first semester, you get told by your professor, hey, history is not about learning something for your life. So it's not the teacher who explains to you how you do things right. But
Yeah.
one conclusion you can come to is that they are not this kind of, I don't know how to say, it's not like you have one cause and it leads to this outcome. So
Hmm.
every situation in your life is complex. A lot of decisions of many people lead to certain aspects. So if politicians now tell you, hey, I will solve your problems, the only thing we have to do is to close the borders, that's most likely not the right answer to your current most important aspects in your life or conditions in your life. There are likely a lot of more things. And if egg prices are high, it's very likely that there are many reasons for that, and not just that a certain president is in the White House. So
Hmm.
I don't want to get into more detail, but I think you can
Yeah.
figure what I mean. So
Yeah. Yeah.
that's something, because you analyze all these situations. For example, the First World War. For a long time, many historians in history, it was like, okay, um, Austria and Germany wanted war, and that's it. So
Hmm.
let's leave it at that and call it a day. Now we know it was actually, it's not incorrect, but a lot of things led to that. So a lot of say conditions in the different states led to that, and a lot of people which were fighting for power in the states. So you have this kind of the aristocrats, you have the kind of military, and also politicians who were fighting for power in this kind of yeah new states which were formed only years ago at this point. And so there were many things that led to this outcome, and it was not that anyone wanted really war. They were thinking a lot
Yeah.
differently about this whole situation. And yeah, I think that's true for every situation which we are now facing, made climate change, made things like that some people are poor and have this kind of issues, that they are not able to pay for food and living. And so there are many reasons for that, and that's something which you could learn from history if you're open for it.
Nice. Yeah, I think that's a great way to wrap up. The the multiple scale of colors of the world is just not like black and white. There are like multiple shades and many reasons for everything. Yeah, it's also what makes it fun, I guess. To otherwise, it would be extremely like objective, and yeah, it would be, I don't know, just boring. So
Exactly.
yeah, I just wanted to thank you for the time you committed today, and yeah, overall, publicly thank you as well for the time you dedicated to me during the past I don't know, almost a year. So
Yeah.
yeah, it was really fun.
Thank you, David. It was a pleasure.